Bitcoin has outperformed every asset class over the last decade. Index funds have made ordinary people wealthy for 50 years. I asked Claude to make the strongest honest case for each and let the actual facts speak for themselves. Disclaimer: nothing in this video is personalized financial advice. This is an educational comparison built using AI research. Always do your own thorough research before making any investment decision. Both investments carry significant risk. Past performance does not guarantee future results. Bitcoin or index funds? Which should a beginner prioritize? The case for index funds. I asked Claude, make the strongest honest case for index fund investing as the primary strategy for a retail investor beginning today. Claude's case was compelling and evidence-backed. Point 1. Decades of evidence. Index funds have outperformed the majority of actively managed funds over every meaningful long-term period. The S&P 500 has returned an average of approximately 10% per year for 50 years. $1,000 invested in 1975 would be worth over $100,000 today through compounding. Point 2. Cost efficiency. Index funds charge as little as 0.03% annually. Active funds often charge 1 to 2%. Point 3. Simplicity. No decisions required after initial setup. No emotional responses to daily news. Point 4. True diversification. A global index fund owns thousands of companies worldwide. No single company failure can significantly damage the overall portfolio. Point 5. The behavioral advantage. Because index funds are boring, investors make fewer emotional decisions. The case for Bitcoin. I then asked Claude, now make the strongest honest case for Bitcoin as an investment in 2026. Claude's case was also compelling, with more nuanced caveats. Point 1. Unmatched historical returns. $1,000 invested in Bitcoin 10 years ago would be worth over $1 million today. No traditional investment comes close to that raw return over the same period. Point 2. Fixed supply. There will only ever be 21 million Bitcoin. As demand grows against a permanently fixed supply, basic economics suggests price appreciation. Point 3. Institutional adoption. BlackRock, Fidelity, and other major institutions now hold Bitcoin. This reduces the probability of it going to zero significantly compared to 5 years ago. Point 4. Potential inflation hedge. Some investors view Bitcoin as a store of value outside traditional monetary policy. What the data actually shows. I asked Claude to compare the historical data side by side without bias. 10-year return, Bitcoin approximately 1 million%. S&P 500 approximately 250%. Bitcoin wins dramatically on raw returns. That is the honest truth. But here's the essential context. Volatility. Bitcoin regularly experiences 50 to 80% drawdowns. The S&P 500 maximum drawdown in the past decade, approximately 34% during the 2020 crash. Someone who invested in Bitcoin at the 2021 peak waited over 2 years just to break even. An index fund investor in the same period recovered in under 2 years. Index funds consistently score higher even though raw returns are lower. Honest data conclusion: Bitcoin produced higher raw returns. Index funds produced better risk-adjusted returns that more ordinary investors actually captured. Practical framework for beginners. I asked Claude, what decision framework would you suggest for a beginner starting today with $500? If you have high-interest debt, pay that first. No investment beats guaranteed debt elimination. If you have no emergency fund, build that before any investing. If emergency fund is complete and debt is managed, index funds are your wealth foundation. Bitcoin, if included at all, is a small speculative position on top. My personal disclosed approach: 80% global index fund, 15% technology ETF, 5% Bitcoin. That is not a recommendation. That is my personal choice after my own research. Bitcoin versus index funds, the honest comparison. Index funds, lower risk, consistent returns, 50 years of evidence. Most investors capture the gains. Bitcoin, higher potential returns, dramatically higher volatility. Most investors do not capture the full gains. The right answer depends on your risk tolerance, time horizon, and emotional ability to handle volatility. Use Claude to research both further based on your specific situation. Claude is free at claude.ai. Subscribe for new videos. See you in the next video.